Well, welcome everybody. My name is Peter Brown. I'm with GHJ. I'll do a brief introduction of the panelists in just a minute. Actually, could you go back to the title page just for a second? We're calling this the post-COVID M&A webinar. I think that might be a little bit of wishful thinking, right? I mean, we're still in the middle of COVID, so perhaps this is the COVID M&A webinar. So next slide, please. So again, my name is Peter Brown. I'm a partner with GHJ in Los Angeles. I lead our forensic services practice. I am involved in a lot of M&A related work, typically when those things go to dispute. I do party appointed work, and I've also on numerous occasions actually served as a neutral accountant and decided working capital and earnout disputes. With us today is Jennifer Lee. Jennifer Lee is a partner with Shepherd Mullen. She has a very interesting practice. She is in their Los Angeles office, but also their Seoul office. I don't believe Jennifer has been to Seoul recently because of COVID, but she does spend quite a bit of time over there normally. She is in their transaction M&A group. She represents obviously global corporations, both public and private. She has a wide variety of industry experience, including entertainment, in media, technology, manufacturing, and she also does financial services. One fun fact about Jennifer is she's most definitely a Bruin. She did both her undergraduate and law school at UCLA. And then finally, we have David Sutton. David is a principal in GHJ's transaction advisory practice. He's doing mostly sell-side transactions at this point, but we represent both buyers and sellers. As you'll hear in just a few minutes, David is from Texas. No, actually, no. David is actually from the UK and has been working in this space for the past 15 years. He's actually seen the whole cycle. So he's done work in restructuring, so the back end of the deals, but he's also at this point very busy doing the front end M&A transactions, quality of earnings type work, mostly sell side, and you'll get to hear from him in a minute. David is feverishly trying to get work done to meet the 12/31 close. A fun fact about David is that he's a chartered accountant, which is different than a CPA, and in my view, it's a harder credential to get. But he also has a master's degree in electrical engineering. So those are your panelists. So let's kick this thing off. So this is what's going to happen. We've already done our introductions. We're going to talk about the deal process and how deals get done. We're going to talk about the current landscape and what we see out there. I'm going to talk a little bit about what happens when deals go bad and the disputes that arise sometimes. We'll open it up for Q&A, and then we'll have some wrap up. So without further ado, let's jump into this. So first thing we're going to do is have our first polling question. So could we put that up? We just want to know who's in the audience today. If you could just let us know if this works, if you could just click one of these buttons, that would be great. And we'll see who we have. Okay, let's see what we've got thus far and we can move on. Okay, so we have a very heavy accountant finance group today. We've got some business owners and we have some other folks, so that's great. So let's continue on. Based on that, I think we have a pretty good presentation for you guys. So let's move on to Jennifer. So Jennifer, give us a primer on the typical deal. What is the process? How does it get done? And just give us a rundown of how we typically see things go.
Sure. Thanks, Peter. Hi, everyone. It's nice to meet you all virtually. So a lot of what I'm going to talk about today is going to be geared towards potential sellers of a business. I'm going to try to keep it general and at a high level. So apologies in advance if some of what I touch upon is pretty basic. But just from the beginning of a typical deal, if you're starting to think about selling your business, I think the first step is to really get a team in place. And that usually consists of accountants like the folks over at Green Hassan, and an investment banker and a lawyer. And I think accountants and investment bankers are especially critical at the beginning to help you evaluate whether this is the right time to sell, what the market looks like, who the potential buyers are, and a very important point, how much you'll get for your business. And so if you decide to test the waters and decide that this might be the right time to sell, there are typically two routes. Sometimes there's a targeted outreach. If you know of the buyer who's interested or vice versa, and the price is right, then that's going to be obviously the most straightforward process. But another route is an auction process. And for those who are not familiar, that's usually where investment bankers will reach out to various potential buyers, either strategic and or financial, to drum up interest and see what terms are available. And it gets exciting when there's multiple buyers who are interested. So as sellers, you can use that to leverage and solicit the best terms and see also which party would be the best buyer for you. And oftentimes these deals are structured as an all cash deal, where you sell 100% of your business and you get cash at closing and you go home. But sometimes, especially nowadays, there are a rollover component, which means you'll get an equity interest in the buyer. And sometimes as executives, you'll enter into employment agreements where you stay on as part of the management and you continue growing the business going forward post-closing. So in those situations, picking a buyer is often about who the right partner would be. And so that's looking at who the right partner could be part of that evaluation. And so once you decide on a buyer, you start the documentation phase. It usually begins with a letter of intent that lays out the basic terms. Oftentimes buyers are going to ask for a period of exclusivity, so you don't go talking to anyone else. And then it's a race to document all the terms in long form agreements. And so it's really, all in all, the process can be as short or as fast as you want it to be, unless there are governmental filings that might be required or third-party consents that may need to be obtained. A closing from the start of an LOI to the actual sale can take anywhere from 6 to 8 weeks to a couple months. But that's when you get to the documentation phase. When you work with accountants and investment bankers, there's obviously going to be a lot of legwork that needs to be done as part of that auction process that I just talked about.
Okay, so there's the typical process. What have we seen with respect to COVID and how has that impacted the typical process?
So from a very nuanced level, from a documentation standpoint, I guess just to back up, when you sell your business, sellers are going to be expected to provide representations and warranties about their business. And if any of those representations are inaccurate, then their sellers are going to be asked to indemnify the buyer for breaches of those representations. And because of COVID, what we're seeing from a documentation standpoint is that buyers are going to ask for representations about how COVID has impacted their business. So if you've lost customers or if customers are have slowed down in making payments, then those are the types of disclosures that you'll need to tell the buyer about. If you have a PPP loan, then it's going to be, you should expect for that PPP loan to be forgiven or paid off in connection with the closing. As sort of a bigger picture level, I don't know if it's necessarily COVID related or if it's driven by COVID, but the M&A market right now is incredibly busy. There's just a lot of activity, a lot of deals getting done, and deals are getting done very quickly. It could probably, in my opinion, be because there's so much interest that one of the ways to be the best buyer, the winning buyer, is to ensure that they're going to get a deal done on a quick time frame.
Okay, so we've heard, at least I've heard, about representations and warranty insurance. So tell us a little bit about this and how it's impacting the market.
Sure. So So one of the reasons why deals can get done more quickly is because we have insurance carriers who are involved who can stand behind reps and warranties. So in the reps and warranties that I talked about, instead of sellers providing indemnification, now we can have insurance companies provide buyers with that protection. And so there's a cost associated with it, obviously. So what we're seeing right now is that the policy limits for these reps and warranty insurance policies are about 10% of the enterprise value. You can obviously purchase more, but it's going to cost a little bit more. The retention is typically 1% of the enterprise value, unless it's a very small deal or a very large deal. And then just the all-in cost, including premium, underwriting cost, it's usually about 5% of the enterprise value. This is of course subject to a lot of caveats, like there are certain industries where the cost is going to be a little bit higher, but this is sort of the typical terms and conditions in a typical M&A deal. But so the rep and warranty insurance coverage really gives sellers the ability to essentially sell their business and walk away without taking on as much risk as they might have traditionally done before rep and warranty insurance became so prevalent. And so if for some reason there's something that resulted in a breach to those reps and warranties, then the buyers can look to the insurance companies to get protection.
So in today's market where everything is moving so quickly, can you use this type of insurance coverage as a way to limit the amount of diligence that you do on a particular deal?
So no, not to limit it, because the insurance companies will definitely want assurances from the buyer that someone has someone has done the diligence to get comfortable with the fact that this business is in pretty good shape. And if there are any issues with it, then those are usually excluded from the policy. But just stepping back, usually a buyer is the one that will purchase the policy, but the cost of it can often be shared with the sellers. And again, that goes back to how much leverage a seller has. But in order for an insurance company to get comfortable with providing coverage, they will want a buyer to say that they've done the diligence and they haven't seen anything that's a material issue. And so I think it reduces some of the tension between buyers and sellers, but it also, it doesn't eliminate the need for diligence, but I think it allows for parties to complete the diligence on a more accelerated timeframe.
Great. Well, thank you, Jennifer. I think what we're going to do now is move to the current landscape. I believe we have another polling question. So we want to figure out basically, can we put that polling question up, please? Talk about sectors and industries here in just a second. Give it just another minute and we'll move on. Don't have that one. We can come back to it. Why don't we do this, Dave? Why don't we move on? Would you go to the next slide, please? And we will talk a little bit about the current landscape. So, David, when we talk about sectors or industries, which ones have really been positively impacted by COVID and which ones have been negatively impacted?
Yeah, it's a good question. And first of all, good afternoon to everyone. I think I would start out, Peter, by just echoing some of Jennifer's comments that the M&A market right now is incredibly strong, certainly the strongest I've seen it in my career. I think a lot, if not all, industry professionals would agree with that sentiment. That's in terms of volume, pace, valuation, all incredibly strong. Probably since mid-2020, that's been the case. In terms of actual industries and how those have been impacted by COVID and the impact on the M&A market, positively impacted, I would say, consumer businesses, particularly those that have a direct-to-consumer or DTC channel, health and wellness, technology-enabled businesses, so not necessarily selling technology, but for example, manufacturers where there's a heavy enablement of technology to actually go through the manufacturing process. Those we've seen have performed very well. Less impact on sort of social distancing and all the other factors that have come into play with COVID, where there's that technology piece to support it. SaaS, for example, as well, so software as a service has also performed well from what we've seen. At the other end of the spectrum, brick and mortar based businesses, travel and tourism, events and event management, plus for each of those, there's a multitude of ancillary businesses that support those industries that have taken the share of that impact as well, whether it's positively or less so. What I would say though is, we do see industries that have performed differently through COVID, but the common theme, I think, is management and culture, where there's an ability to pivot and just to be nimble in such a significant period of change. And that can mean pivoting to new markets, developing new products or services, selling through new channels, even the cost structure in the P&L and the quality of the balance sheet, and its ability to absorb, the shock of COVID and the pivoting that everyone had to go through. So there is some industry dynamics for sure, but certainly management and culture and the ability to adapt during such a period as we've seen with COVID has been significant as well.
So what's really driving the market now?
So the way I think about the M&A market is it's similar to any other market in a lot of ways. Supply and demand is what drives the market, both in terms of volume and in terms of pricing. So on the supply side, there's a lot of consumer demand. Some of that is pent up from COVID restrictions, and a lot of it is sort of natural consumer demand that's out there, if you will, as GDP continues to grow. So there's a lot of well-performing businesses, both driven by consumer demand and also separately. So good supply of companies. On the demand side, there is currently a fairly low interest rate market. So there's a good availability of debt to leverage transactions, which means that buyers can really generate significantly stronger returns through debt leverage. So low interest rates is driving that. You also have financial buyers who have a lot of cash ready to be deployed, so dry powder, as it's called in the industry. So good amount of demand that's coming from the want and need to deploy those funds. So, in summary, you have a good amount of companies that are performing well. That generates a lot of supply, so there's a good amount of volume, but even stronger on the demand side in terms of lower interest rates, capital availability, a lot of roll-ups that are happening that generally gives rise to not excessive demand, but stronger demand as well. So when you put all of that together, you have a good amount of volume that is going through transactions, but then you also have very strong pricing. So it's very seller-friendly market at the moment from a pricing perspective, as Jennifer talked about as well.
Well, so that's interesting. You talk about a seller's market, right? So what would be motivating a buyer at this point to get a deal done?
Yeah, so as I mentioned, there's leverage returns and the availability of debt capital really drives stronger returns for certainly for financial buyers, to a degree strategic buyers as well. The caveat there is that sustainable? And we talk about this a little bit more shortly, but Jennifer mentioned doing diligence and reps and warranties and so forth, and really speaking to the history of the performance of businesses. There's an element there of ensuring that that is sustainable going forward, and that's where we're seeing stronger multiples, being the multiple on earnings that a buyer will pay. So, you know, the ability to leverage that, again, notches up those returns for financial buyers. And on the strategic side, we're seeing, as I mentioned earlier, roll-ups, meaning company may already be operating in a certain space. That existing business would be a platform to then add additional businesses on top and really soak up market share through the acquisition of other businesses. That, again, there's synergies, a lot of good synergies available there, generating future growth, and buyers are willing to pay good valuations for those roll-ups and those bolt-on acquisitions. So from the buyer side, there's good motivation across the board, really, to get deals done.
So we did have a question from the audience, and I think it's very good on the sell side, right? Going into 22, what are the headwinds so that you could potentially see that you would actually want to try to get a deal done now as opposed to after in 22?
Yeah, there's probably a couple of pockets, I think, that could potentially be headwinds. I do think 2022 will continue to be a strong market, but if you look at supply chain, logistics, labor, those are all potential items that may become stronger headwinds in 2022. Tax is the other one that's driving sellers, I think, more to market now. It's not yet currently clear what the tax rate change would be or when it would take effect, but I think we can all agree that there will be one. So that's bringing some sellers to market perhaps more quickly than might otherwise be the case. There's maybe a couple of other factors as well, but those are certainly the big ones that jump out.
Just to add on to that, I'm hearing from a lot of the PE firms in particular that they are just so overwhelmed right now with the deals that they have for this year. And rep and warranty insurance carriers are also pretty overwhelmed. So to the extent that you're considering doing a deal this year, it might just be challenging challenging logistically. So if it's something that you are thinking about getting onto it sooner rather than later, I think would be advisable.
Yeah, I think that's true, right? If we look at our practice too at GHJ, I think we're pretty much sold out for FY21 at this point. Is that a fair statement?
Well, yeah, not only that, there's the length of time that it takes to complete a transaction. We're at the end of September, so if folks are thinking of a transaction before the year end, then that train needs to be in motion pretty quickly at this point.
Yeah. Well, I've gotten word that our polling is now back up and functioning. I think what we wanted to do is put up the last question, which was really based on sectors and industry. So if we could do that real quick and then we'll move on. So what is your industry? If you could just let us know. I saw that we were pretty heavy in accounting before, but let's see what else we have. Okay, let's see what we've got so far. Okay, so we don't have any private equity guys on the line. That's interesting. And real estate professionals. So we've got a lot of accounting and a lot of other. So good. The other is very interesting to me. I'd like to. We don't have any way to interact with folks, but I would love to hear what other industries we have represented here today. So with that, let's move on. The next piece of this is really what I was going to talk about is when deals go south, right? And let's first talk about the purchase price mechanisms that are typically in a deal. And normally what you see is you'll see that a deal gets done based on an interim set of financial statements. So let's assume we're sitting here in September. We ink the deal today, we pop the champagne, everything's great. But there's going to be a true-up typically that comes, and let's say it's at 12/31, the auditors come out, we've got an audited financial statements coming down the pipe, and so we agree that, yeah, we'll do the deal based on some interim numbers today, but we're going to shake everything down based on year end, and to the extent that there's going to be changes, and what we believe the accounts show today, we will have a purchase price adjustment. And so what are the typical purchase price adjustments? I look at the world really in terms of a balance sheet and an income statement. And what you normally see with respect to an income statement would be like an earnout dispute. And what Jennifer said is, listen, it's a seller's market. And what earnouts typically do is they give, obviously, more compensation to the seller. Well, if the seller can demand all cash today, they'll probably try to avoid the uncertainty dealing with an earnout. But if they want to continue to have a piece of the business, right, they believe the business is going to continue to perform as it had and maybe even grow, well, maybe they want to have a little kicker in there as well. So the earnout still could be attractive in certain instances. On the balance sheet side of the equation, I mean, you look at, typically what you're going to have is like a net working capital adjustment. So working capital, again, is current assets minus current liabilities. And so if there's a change in working capital between the interim and the final, typically that will give rise to a purchase price adjustment. Now, why do they do that? And I did a little research on this. It actually goes back in time. I mean, it's not what people really think about it today, but back, let's say, in history, you'd have the same situation where you have a interim balance sheet and a closing balance sheet. Well, the seller would sell sell the business, let's say, and then they would just essentially do the proverbial, truck at the loading dock in the middle of the night and then just take all the inventory out of the business. Or they would just basically say, send out an edict, from here on out, we're not paying any of our vendors, because that's going to be the buyer's problem when they take over the company. So there's good reason to have a net working capital situation. If there's a reduction in inventory, let's say, well, that's going to adjust the purchase price. And let's say you haven't paid your vendors or you have an increase in accounts payable, that's going to reduce your purchase price. So those types of things, I mean, the net working capital adjustment is designed to do that. The other thing that's interesting about purchase price disputes itself is you'll see in most of these agreements, it's not a lawyer or a judge or that's going to actually hear these disputes. It's typically going to be heard by an accountant. So I used to work at PwC. I did a number of these deals where I was the arbitrator, and the phone would just ring and it would say, hey, we've got a deal. It says that PwC is going to hear this dispute on an earnout or net working capital dispute. Do you have anybody at your firm that can do that? And I would always say yes, and it was great. I mean, it was a great source of work, but you never knew where it was going to come from. So it's a good piece of work if you can get it, right? So it's typically heard by accountants, not by lawyers. So you typically draft your agreement or your arguments to be heard from an accountant. So it's accounting arguments. It's not strong on law, that type of stuff. It's really just kind of explaining what happened to the underlying accounts. There's a number of things that typically come up that are, common disputes. The first is you'll see in pretty much every single deal, it says GAAP consistently applied. And so first of all, GAAP is not a panacea, right? GAAP, typically, you can drive a truck through. Think about GAAP, LIFO and FIFO. Well, if you value your inventory based on last in, first out, or value it based on first in, first out, right? You're going to get a completely different number. They're both GAAP. So first has to be GAAP, and then it has to be consistently applied. And what you'll see in a lot of deals is that the seller actually has a non-GAAP type of accounting. We just did a deal where the seller had, it was a SaaS, a software as a service business. And they used to recognize revenue as a private company, just like consulting companies do. When their engineers and developers charge time to a job, they recognize the revenue. Well, they sold the company to a company now to the buyer now recognizes revenue based on ratably over the entire contract length. Well, from the seller's perspective, in the earnout, they expected to get their money up front. Now it's being spread over a number of years, and the seller and the buyer thinks that the seller's not owed anything pursuant to GAAP. Typical dispute that you would see. The other dispute that you typically see is materiality, and we see this in most disputes as well. What's material, right? Well, if I'm a seller and I have an earnout, I think $1 is material. I mean, it's like if I have a purchase, if I have an interest in something, I want to be paid. And so, you know, the materiality is basically $1. Well, we see buyers, you know, often argue that, wait, and we took over the company. You could look at a definition of materiality as whatever the auditor says material is, or it could be whatever the management of the company thinks it, you know, generates a change to the financial statement. So some higher level of materiality, and we see typically that would happen is turns into a dispute over materiality. The other couple of areas where we see disputes is in subsequent events. You really have 3 different points of time here when you're talking about a dispute. You have an interim financial statement, you have a closing financial statement, and then you actually have a decision by, let's say, a neutral accountant down the road. What is the balance sheet date, right? Is it the interim day? Is it the final day? Or is it actually the date when you get the final arbitration decision from the neutral accountant? Depending on what that date is, really affects how you do the accounting. And so there's really no uniformity in practice either on this. So there's different folks have different views on this, and this leads to disputes. So those are the disputes. With respect to working capital itself, so let's talk about balance sheet disputes. The typical things you see in every dispute is going to be receivables, right? The seller believes that 100% of their receivables are collectible, right? The buyer comes in and basically says, this stuff's all junk. We need to write this stuff off. We're not going to collect any of this stuff. And so you have this dispute between receivables. The seller thinks that all of their inventory is good. The buyer believes that everything's obsolete and slow moving, so they try to write everything off, right? So this, again, it's a typical thing that you see in disputes. The other thing that you see typically is you'll see the buyer come in and they will like to create provisions for everything. So they want to have accruals for bonuses, they want to have accruals for bad debt, they want to have accruals for inventory, and they think that all that stuff should be booked before this thing is decided. Seller obviously has a different view. We've already talked about you know, GAAP issues, but that comes up in spades on the working capital side as to you know, how do these different interpretations of GAAP lead to disputes. On the earnout side, you have income statement disputes, and the biggest problem we see with earnouts is how the language is drafted in the agreement. No offense to the lawyer, Jennifer, on the phone here, but the lawyers sometimes write earnout language that is completely indecipherable for an accountant to understand. I mean, you can read what the words say, but you can't understand how to actually apply it to actually do the accounting. So that's the #1 problem I see. The other thing that you see is you look at the definition of earnout, and it can be anything. It can be EBITDA, it can be some form of net earnings. If it's gross revenue, that typically is better, but still it leads to disputes as to how you do revenue recognition, et cetera. And the other thing that we see too is the seller sometimes will only get a piece of the sales. So let's say just the customers that they had before they sold to the buyer. Well, trying to peel out those sales can be difficult and leads to disputes. And so we've seen a lot of those types of things come up in previous deals. The other thing that really complicates it is if you've got an industry or a buyer that's doing a roll-up and is actually doing multiple deals concurrently, how do you separate the seller's activity, this particular seller's activity, from other activity, and how does that get treated with respect to the earnout? So all those things are complications, and it leads to disputes. So the best thing to do is to have good record keeping. Unfortunately, after the fact, most of the time you don't have the records that you really need in order to do a good accounting. With respect to COVID itself, I don't know that COVID has really impacted we're seeing more disputes that are COVID related. We're just seeing more disputes because there's a lot more volume out there in the market, right? So there's a lot more M&A disputes out there because there's a lot more M&A activity. Okay, so that's just a little bit on disputes. Let me just check real quick on the questions, because we have a couple that came in. I think we're good. We can leave those for the end. So we're going to go to the next topic, which is the crystal ball. So what I'd like to do is see, let's put up that one polling question that deals with the future, and then we'll go from there. That's this. Can we go to question 4?
Peter?
Yep.
Your camera is off.
Okay. Yeah, I think something happened. I'm back. Let me see if I can put it back on. You guys see me now? Yeah, I froze. For some reason, I froze, yes. And then it just kicked off. So I apologize. A little technical glitch there. So here's the
COVID webinar, Peter, if you don't have that.
What's that?
It's not a COVID webinar if you don't have that.
Right. Okay. So here's our last polling question. Have you been involved with, or are you planning to sell business in the next 12 months? Oh, wow. So we got a pretty good mix here, folks. Okay, with that, I'm going to turn it to David first. David, get out your crystal ball and tell us what you think coming up in the next 12 months.
Yeah, I wish I had a crystal ball, I can tell you. But I do think, I mentioned this briefly earlier, 2022 does look to be a strong year from an M&A perspective. There's maybe a couple of headwinds which we can talk about, but when we think about the volume, the pricing, the demand and the supply, which all things put together dictate the M&A market, those things all look to be in place for a further strong year in 2022. COVID, when it did initially hit in 2020, proved the resiliency of the broader economy. I mean, for sure, there was an impact, and there was, you know, a period sort of late Q1, early Q2, where there was a lot of uncertainty. 18 months on, you know, the economy's performing well. There is pockets of sort of labor and supply chain where there's some disruption and sort of crunch, if you will. But overall, the economy does appear to be in good shape and has weathered the COVID impact relatively well, I think, all things said and done. When you look back at history, you know, an M&A cycle tends to last 8, 9, maybe 10 years. So we're towards the back end of that just based on historical trends, but there's nothing out there that suggests we're at the top of the market right now. So I think most commentators do look at 2022, myself included, and say it looks like it will be a very active year. It will continue to be a seller-friendly year, we think. Interest rate increases, inflation, supply chain, as I mentioned, and some labor crunch may soften some of that relative to now, but I certainly don't see it turning around full circle and becoming a buyer's market in the next year or two. We're seeing a little bit of buyers who are looking at transactions and saying, we're either going to be fully in and put our best foot forward from the get-go, or we just won't submit a bid at all. That's not currently impacting, nor do I expect it to impact in 2022, the number of deals that are happening and closing and the valuation at which they're closing. It's maybe meaning the number of bids is not as high as it might have been previously. But again, looking into 2022, there's nothing currently that suggests the level of transactions and the valuation of those deals would taper off. Maybe slow down slightly, but certainly I think we expect more of the same next year, as we've seen at the start, middle, and really looking into Q4 as well of this year to continue from an M&A perspective.
Well, any reason why a seller would not want to go to market? What are the specific facts why they would just hold off completely?
Why they would not want to go to market now?
Well, maybe even
selling a
22.
business. Yeah, selling a business is, for a lot of folks, is a once in a lifetime. And particularly for owners who've grown that business from scratch, it's their life's work, and it's something that's very close and proud, and rightly so. So selling is not necessarily a decision based purely on whether the market is a seller's market or a buyer's market. There's a lot of individual decisions that go into that. When I spoke about tax earlier, that in and of itself is not necessarily a reason. Businesses that are growing strongly may yield higher after-tax proceeds in 2 years from now, even with a higher tax rate. Some individuals may prefer not to have a rollover, as Jennifer talked about. Those are becoming a little bit more common, and prefer to sell a business and be done kind of 100%. So that may be a structure that's bubbling up more so in the marketplace that doesn't suit some individuals. So it's a very individual decision, I would say. But those are a couple of reasons why a seller may not look to sell either now or even next year.
Another good question from the audience is, can you comment on trends and valuations have you seen, or do you expect significant increases in multiples? Want to take that one, David?
Sure. I think it depends to a degree on the industry. Certainly different industries will attract different multiples. Whether we expect a change in multiples going forward, I wouldn't think so, unless there's a particular reason for a particular transaction, whether it's highly strategic or whether there's a golden nugget that's driving the valuation relative to other multiples in that particular niche industry. I think multiples are relatively high now. The traditional view of multiple, if you really wanted to, back of the envelope, what's my business worth? People will tell you, well, 5 to 7 times earnings is a good multiple to go on. I think those days are, 5 to 7 now would be thought of as low. So we're probably more towards the 8, 9, maybe 10 multiple. But I don't see those creeping up further from where we are currently. Again, there's a lot of variability in there depending on the particular business and the industry and so forth. But I don't see a reason why multiples as a whole would step up next year compared to where they are currently.
Jennifer, do you have any thoughts on that based on the deals that you're seeing? With respect to multiples specifically, we've got other questions I want to get to.
Yeah, I'm not as close on the multiple front, but just in terms of, I think the question about, I guess, headwinds and going into why wouldn't we go to market now? I would just echo David's point about it's a very individual specific question. It's a lot of times this is really the baby of the founder, of the owners, and so it's not just always about the price and the right time. It is a lot of work at the front end about marketing your company, putting together confidential information memorandums that just describe the company. There's a lot to do. So I would just always caution that people really, if they want to start thinking about it, to build in a lot of time to do so.
Yeah, and just back to you too, David, on taxes. I mean, we see that some of these transactions are tax motivated, right? But are taxes really the only consideration you have here, or what are your thoughts on that?
Is tax the only consideration? Absolutely not. Personal goals, I think, is what it all comes back to. And one of those goals for a seller might be, the wealth and what the plans for that wealth are post-transaction. So after-tax dollars is a component of that. but there are many, many components, including, lifestyle, drive, and whether there is an appetite to continue to be involved in a business after sale or not, or go and do something else. For example, there's a lot of different factors that are there. Purely from an economic standpoint, I would say tax is one of the larger factors because it drives the availability of proceeds, cash after tax proceeds upon close. So it's one of the larger factors from an economic standpoint, but I do think that the economics of selling a business is only one of several considerations that a seller might have.
Mm-hmm. Another question regarding, I think, multiples. Is there a post-COVID deal structure out there? Meaning, let's assume a client offered a high EBITDA multiple for a pre-COVID deal in 2019, plus a range for 2021 based on, future earnings. So what do you think of that structure? Do you think that 2019 pre-COVID baseline of multiples are still good today, or do you think everything has changed at this point?
It's a great question. And, what I would say is that we've certainly seen transactions where 2020 results have just been discounted from a valuation perspective, for sure. There's just so much noise in there, both in terms of top line, margin, and OPEX. I do want to link this question back to a question that was asked earlier as well about going to market with some sort of preemptive diligence or quality of earnings. And we are seeing more of that. I think most, if not all, transactions are going to market with quality of earnings. And the reason I link those two together is because looking at adjustments in 2020 can be highly subjective. For example, we had a transaction where there was a direct-to-consumer channel and also a retail channel. Retail channel, as you'd expect, had some slowdowns. Direct-to-consumer channel performed very well. How do you figure out whether the revenue in direct-to-consumer came from the retail side and those two things are offsetting each other, or whether it's actual organic growth net-net? It's very, very difficult to prove that. And even if you could, how much does that drive the valuation is a big question mark. So for that reason, I do think looking at 2020 through a slightly different lens is appropriate. Looking at 2019 solely is perhaps less appropriate because that's well and truly in the rearview mirror now. And I think COVID has been with us for long enough that there are permanent changes in business models and in how buyers are looking at businesses. So I think you end up somewhere in between. 2020 fully adjusted probably makes some sense. 19 as a baseline would make sense, but you also have to look at current year performance. So there's no real one-shot answer. At the end of the day, a buyer and a seller will come to an agreement on pricing, and the multiple shakes out where it shakes out based on the valuation and most recent earnings. So I don't think there's a black and white answer there. Buyers will play, their best hand in terms of how to value the business, and sellers will play theirs, and hopefully there's a meeting in the middle that then a transaction will happen. So that's how I think about it. I don't know if you want to add to that, Jennifer, at all.
Any thoughts on that, Jennifer?
I mean, I think from what I've seen on a documentation standpoint, 2020 and 2021 to some extent have been disregarded, but I'm not as close to it as David is. So but I do echo everything that David said here.
Yeah. Jennifer, I have another question, and I think you can touch on this one, is when should a seller look for selecting advisors, and when's the right time to start building that team?
I mean, I'm going to keep on harping sooner is better, just because I think there's just a ton to do to get ready to go into market, because you want to show your best face when you start looking for buyers. And having clean records, having organized records is always going to make your business look even better, frankly. And I think the messier things are, the more concerned buyers get and the more diligence they end up doing. So I always advise starting soon, cleaning up as much as you can. So when a buyer does due diligence, they really don't uncover much and there shouldn't be any surprises. And the best way to do that is to have advisors who know what buyers will look for, to let you know the material areas that you should start thinking about and sort of cleaning up so that they're in the format that a buyer would typically want to see.
Mhm. You know, I'm going to ask myself a question. How do you go about avoiding disputes from an M&A transaction? In my view on this is you really need examples. So I would actually attach to the purchase and sale agreement an example of what an earnout would look like, or what a working capital, change in working capital purchase price adjustment would look like, and make it very defined so there's not a lot of ambiguity there. So that, you know, if you want to avoid disputes, stick in examples in the agreement.
I'm also personally a fan of trying to, if you're a seller, trying to eliminate earnouts as much as possible. Earnouts are just a recipe, in my opinion, for a lot of disputes in the future. So even though interests are aligned in some ways, if the business grows, it's good for both the buyer and the seller. A lot of times we've seen the opposite, where businesses don't grow as much as people anticipate. So to the extent that you have the leverage and the ability to eliminate earnouts from a seller's side, I think that would certainly be the preference.
Okay, I'm going to leave it open just for a few more minutes. Do we have any more questions from the audience? If you want to just go ahead and throw those in now, that'd be great. Just leave a couple minutes here. Okay, here comes one. Here's a good one. How do you see the labor market going forward? David, why don't you take that one?
You know, I'm not a macro economist, but I'll do my best here. I do think that the labor supply has to come back. And I say has to, not in the sense that we need it to, but ultimately, you know, people go to work to earn a living. And whilst in the last 6-12 months, we have seen some of that tighten up and down sort of the labor chain, I do think that will return. I do think that we'll see more people coming back into the workplace, both physically and virtually. And I think that we'll start to see some softening of what is currently a very, very difficult talent environment. And I mean that from the perspective of executives and leadership. And then also, you know, all the way through to operational level folks. And, you know, we've heard of businesses that, restaurants, for example, that can't open because they don't have the servers and the chefs and so forth to operate. And then the same at the executive level, where there are needs for strategic leaders and not having those folks available. They haven't disappeared. They're out there, and the market will come back to the point where there is a good supply of labor and talent to fill those roles. So I'm confident that will come back. I'm sure there's deeper answers and research out there to study that. But one of the things I'll just add that we looked at is, if you go back to the economic impact of 9/11, for example, the consumer-led reaction to that was very, very strong and drove a lot of the economic recovery after 9/11 happened. We see a lot of that now in terms of consumer demand coming back, and I think the labor market will follow the same trend. So I believe, and I'm hopeful that the labor market will become less tight than it is now going into next year and beyond as well.
Mm-hmm. Another great question is on the vaccines, right? Do you think a vaccine mandate for businesses is a key selling factor? Do you think that the owners are going to want to get out rather than have to deal with mandates going forward. And have we seen any of that? Has there been any of that in the deals that we've seen thus far? Jennifer, have you seen any of that yet?
Sorry, I have not yet seen it in any of the deals. I think it's certainly a very hot topic these days that I don't know if there's necessarily a right answer.
Have we seen that in any of our stuff, David?
I have not. It's an interesting question. I think we'll start to see that probably late this year, maybe early next, whether the vaccine mandate by the seller it has an impact on how the buyer looks at it. I suspect there's a lot of legal ramifications there, less so sort of the deal economics and the results and the financials of the company. I think it's probably more of a legal factor, but I have not seen that as yet. I think we will do soon, though.
Okay, any other questions? All right, thanks a lot, everybody. We really appreciate your time today, and thanks for joining us on another GHJ Shepherd Mullen webinar. Take care and have a great rest of the week.